The Inflation Enhancement Act, I guess we'll talk about it, where the
by
money's being
by
spent.
by its we call it the Inflation Enhancement Act, but by its legal name, the Inflation Reduction Act, right? Its government name is Inflation Reduction Act, but we know it as the Inflation Enhancement Act.
Yes, because spending $400 billion on green energy plans and tax credits is deflationary.
Deficit spending.
Oh,
We live in a world where deficit spending is somehow deflationary.
Welcome to the Money Huddle, a podcast that discusses financial topics for families, retirees, and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Advisory Alpha. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Advisory Alpha may maintain positions in securities discussed on the program.
Ladies and gentlemen, welcome back to the Money Huddle. This is season 4. I don't think we've never officially done seasons, but maybe we should do seasons
oh,
since
buddy, we're doing seasons.
we kind of we love football. We love to get going during football season, and then during the summertime, we just kind of take the time to have vacations and enjoy life a little bit. And so, this is unofficially or officially the start of season 4 for the Money Huddle. So we'll run with that. Ross, how are you, buddy?
Great to see you. Thanks to our listeners. We got some feedback. Hey, where have you been? It's funny. I went back and checked in on our last podcast episode, and we were talking about our kids embarking on summer break, and here we are, the last week of summer before my elementary and middle schooler go back next week. We've got meet the teachers tonight. But all
Yes.
right, we got to pause here for a second. Can we just talk about how nice your studio is?
My studio,
My
it's
goodness. We've got the soft blue lights in the back.
bro,
This
I'm
I see
leveling
Michael
up.
Jordan poster in the
You
back.
like that?
This is oh my
I'm
goodness.
I'm leveling up, man. I'm just doing it. I'm doing
I,
it.
I'm here in our office at Fort Mill, and there's a mosquito flying around here, just blood sucking my head. I mean, honestly, this I
That
told one of you
mosquito,
the other
that's
day.
your new IRS agent. That's been assigned to you, bro.
So
He's just moving in.
oh my goodness. So to our listeners, obviously we saw the news come out from the Inflation Enhancement Act. I mean the Inflation Reduction Act
Right.
that we are set to add 87,000 new IRS agents. So we'll have a
Yeah.
little closer contact, I guess, with our IRS professionals than we
Yeah.
have in the
It
past.
was like one of those Oprah giveaways, and you get an agent, and you get an agent, and you get an agent. Which is, to me, it's funny because the story behind that is that they want to ramp up enforcement. And well, enforcement is code for audits,
Sure.
and because yeah, obviously, and then of course the argument is, oh well, if you're not doing anything wrong in your taxes, you shouldn't worry about an IRS audit. I actually saw that on Twitter, and I'm like, everybody worries about an IRS audit. It's stressful, it's anxiety driven, and no one enjoys paying taxes anyway. And so now we're going to add increase the likelihood that you may be audited. And of course, I know a good portion of our listeners are small business owners and people who work for small businesses, and you think about all the things that small businesses have to be accountable for. And now here's just
Sure.
yet one more thing to make sure, oh, we didn't slip up on a payroll issue here, or we didn't have, um, you know, income that was reported incorrectly here. So, um, no
I
one's
would can
excited
I
about
just
that.
comment on that real quick? I mean, I think there are instances where people are abusing the tax law, meaning, just think about this last couple of years of the crypto mania investing where, if someone made $600,000 in short-term gains on a crypto asset and didn't file a tax return on it. I
Yeah,
want those people to be audited. Frankly, like I think
sure.
that's just abuse. But you're right. What happens is, a small business owner is audited, and the tax system is not black and white. There's gray areas. There are interpretations of rules, and you could go and visit 5 tax professionals and get 5 different answers on how something should be considered. So even if you believe that you're doing things correctly, you
Hmm.
have a tax professional, you're getting guidance. It doesn't mean that you could be audited and not find that an agent has a different interpretation or view. And like you said, even if it may not be the yeah, that you end up paying a significantly more amount of income or state tax. But the process of going through an audit is time consuming. It's nerve wracking. It's it, look, they're
No one
digging
wants
into
to
your
do
life.
that.
Nobody wants it, and so right. I think everybody that we work with is just like, look, I want to pay my fair share. I don't want to break the rules, but they also don't want to have their privacy invaded in that regard. And so I think part of it, the IRS was far, far, far behind on reviewing tax returns. So from the COVID shutdowns, just people not having agents in the
Right.
office to do the work, they were behind. So I think there's probably some legitimate need to boost staffing. I mean, phones weren't being answered. Tax accountants couldn't get IRS agents on the line. You'd be on hold for hours. I mean, there was obviously issues there, but this is kind of the flip. Like this is the pendulum flipping back the other way significantly.
Yeah, to me, it's one of those things where, President Biden, whether you voted for him or did not vote for him, one of his campaign promises was he was not going to raise taxes on, quote, the middle class. And so this is one of those, in my opinion, it's like sleight of hands where, hey, I'm not going to explicitly raise the tax brackets, but I am going to, step up my agents for enforcement. So the likelihood of people being audited is going up. And of course, I mean, there are things like that can be triggers for audits. Like if you are an LLC corporation and you make an S election, as a business owner, and then, the language in the tax code is pay yourself like a reasonable salary. Well, what's reasonable? Who now gets to decide? And we do know that that gets abused, but then there are people that are doing it the right way. And now those people could likely see increased risk of audits. Just not a fan of it. I think if we want to, to me, my stance is continually, if we want to raise more tax revenue, we need to increase the tax base, meaning that means more people paying taxes. And the way we do that is we close loopholes, we simplify the tax code, and we make I think a fair, flat tax makes sense. But what do I know?
Hey,
I'm a nobody.
so
I
here's the
live
deal.
in a red state.
We can't start our fourth season in a tax spiral. So let's get
You're
out of
right,
that for
you're
a
right.
second. Let's resurface. So today,
Let's
I
talk
was
about
actually
inflation, a much more
yeah.
cheery
Yeah,
subject.
yeah. So let's go from taxes to high prices. No, so last episode we kind of left everybody going, is this a bear market rally? Is this sort of are we
Yeah.
going to see a little summertime bounce? And so just wanted to circle back to our listeners. And so the 1 month return for S&P 500, just looking at Y charts yesterday, was 7.38%. So the S&P 500 bounced a nice month. It was welcome, right? Open
Mhm.
arms. Let's have a little bit of. I think the pessimism and
Yeah.
negativity was as high as I've seen it in a long time. I mean, every news article, every earnings report, they were picking it apart, looking for any negativity they could find, bringing it to the surface, and it just got a little suffocating, and it just didn't make sense compared to where we were at the time. So
Yeah.
we sort of said, hey, look, I think we might have a little summertime rally. We did. Um, it wasn't like explosive, but we got a little lift, which we'll take it. And
Well, I
so
think,
to,
to just interrupt you for one quick
mhm,
second, you were absolutely right. It was really dire there for a little while, especially end of May and through June. And so the point that I would make here is a lot of people really started to end of June, first part of July, when they were getting June statements, getting really frustrated and wanting to pull the plug. But again, this is one of the reasons why we coach people about pulling the plug due to emotions, because July was a tremendous month for the markets.
correct.
So if you were really frustrated and June, excuse me, June was the month that just, broke your back, if you will, as an investor, and you bailed, then we missed July. and July was a tremendous month. And so this one of the dangers of trying to let your emotions drive your investment policy.
Right. And so as you can see, my I've named myself better than feared. Well, that was sort of the theme I took away from second quarter earnings this year was it wasn't stellar. There weren't blowaway reports necessarily. I mean, obviously it's a mixed bag because everyone's reporting.
Hmm.
So you've got some disastrous, some great. But I mean, in general, I think it was better than feared. We were sort of bracing for impact to see some worse revenue numbers, some worse earnings numbers, and it didn't materialize, in broad scope with the market. I think it was a little bit better than feared. However, the future is murky because guidance in some cases is being lowered or not given, and
Hmm.
there is still a lot of talk about is there more pain to come. So I think we just have to be open minded that there's going to be some undulations here. We've got a lot of things to suss out. And one of those came out this morning. So let's talk a little bit about this inflation report. It just posted about 30 minutes before we hopped on here. So
Right. We actually had a great conversation in the office yesterday about this. And so, just for our listeners, CPI came out today. Annually, the year over year number was 8.5%. So it was actually less than it's expected. Core CPI was up to 5.9%, and it was actually a 0.3% increase. I think still a little lower than they expected it to be, but it was an increase in month over month. And I think we're going to start to see a divergence in the story with inflation, Ross. I think we may start entering into a period where we see headline CPI decline, but some stickiness with that core number, because there's some components of the core number that we're going to have to deal with. And, we've talked about home prices. And so owner's equivalent rent, food, some of these things that are going to be a little stickier, they're not going to just go away and, completely mitigate if gas prices were to revert downward to a quote, an acceptable level. What are your thoughts?
so my big takeaway was the gas prices fell.
Hmm.
I think the number I saw was 7.7%. Something, let me see if I can't pinpoint that number real quick. Yep, 7.7%. So it's kind of interesting, right? 8.5% inflation increase is a good number. That's a little alarming, right? We're in new territory that we haven't been in 40 years, where we see an 8.5% inflation number and go, "Wow, it's pretty good. It's
Yeah.
better than expected. It's better
Market's
than feared."
rallying on that number.
Right. Is better than feared. So we're rallying on that number today, but we're seeing gas prices come down. That's one of the major pain points that consumers have. Just is you see it every day. It's in your face. You go to the pump. You go, wait a second, this is insane.
Right.
Gas was pushing $5 a gallon here in South Carolina. You just look at that and go, well, this isn't sustainable, and it's back down to a more reasonable level, right? I'm seeing gas prices in the $3.50 range a gallon here where we live, somewhere in that range, right? We're
Hmm.
we're not too far off. The one thing that stuck out to me was food prices. So this is the quote from CNBC article. The jump in the food index put the 12-month increase to 10.9%, the fastest pace since May of 1979. Um, so we'll keep an eye on that. Obviously, that was one of the fears coming out of this Ukraine-Russia conflict that
Hmm.
they're the breadbasket of the world if they're not distributing fertilizer, wheat, food sources to other countries. It may not be coming to us, but to other places in the world that we need that
Correct.
to see. So we'll keep an eye on that. And of course the housing prices you talked about, rent and just the way they calculate housing increases. It is on a little bit of a delay, so they smooth those numbers out. So the effects of that aren't felt immediately in the CPI number, and so there's going to be a little bit of a delayed sort of bringing those numbers
Yeah.
in, and that's going to probably help keep that core index elevated for longer because the housing explosion in prices really, I mean, that's pretty material. I actually looked at, if I can find that report. Oh, here we go.
Well, I'll hop
Yeah,
in
go ahead.
really quick. I think again we're going to see probably the divergence in these inflation numbers because gas prices, if they go down, they're probably not going to go back down to where they were. The other component of that is actually, I read an article today by Sam Rowe, and we'll make the link available for people who want to check out the show notes and the show page. But this article, he talked about this concept of, I think it was employee or labor hoarding, and the premise was a lot of companies, they lost so many people and laid off so many people during COVID, and then they tried to rehire talent, and it was really hard. And even you've heard stories for a while where people were trying to find employees, and they couldn't find them. There was a little bit of a shortage, and so now that some of these companies have people, they're going to be much more reluctant to let them go, even if we do go into recession, just because just may be more cost effective to hang on to the employees. I thought that was interesting, but it did make me think about this other component of inflation. If you think about service jobs where people got let go, and then it took, instead of, $10 an hour or whatever you were making, now you had to hire back at $16 an hour. Well, those people aren't going to start working for $10 an hour again. They're going to stay at $16 an hour. And so you've got this wage thing that's happening. So if wages remain, elevated, they don't go down. That might put a little bit of a floor on this inflation number about how far it can fall. Because if people are going to have jobs and they're going to spend, then it starts to me to look like, well, do you think prices are going to continue to increase? Because if you've got money, then naturally people are likely to say, well, if prices are going to only increase, I better buy today, which buying, maybe get more price increases. So it's going to be interesting to watch play out for sure.
So we so we did officially have 2 negative GDP quarters.
Oh, but we can't call it a recession anymore. We changed the definition.
Right. We had it's but this is
It's a
confounding.
recession. It's a recession.
But this is what makes it confounding, right?
Yeah.
So we did have a good jobs number. It hit more jobs added. This was just so at the end of last week, right, where that jobs report came out. It was a little stunning to the positive side. There are still 10 million open jobs, and I know the open jobs are changing and they're lowering.
Right.
And I do think that we may see more of that. But it is I think confounding is a good word. Excuse me, because good luck predicting what's going to happen over the next 6 months to a year. We're
Right.
in a pretty interesting situation. We have 3.5% unemployment. We have 10 million open jobs. We have a stronger labor market than before, but inflation is eroding some of that, and prices are still eating away at
Well,
consumers. So
the question that I think, begs to be asked is, did we add 500,000 jobs in STEM fields, or did we add a whole lot of service sector jobs? Which, if you go back and you look at where we were, in the first part of the year, we talked about inflation transitioning from goods to services.
mhm.
And we knew, we expected, with it getting warmer, more people are going to travel, more people are going to go out and be out and about and do stuff, spend their money on services, which, allowed, there was demand in these, service sector positions. And that's where I think a lot of these jobs have been added. And the question is, are some of these seasonal hires? Are they temporary? Where we have increased demand right now during the season, so we have to add employment. I don't know. I think that jobs number might have been a head fake. Personally, we'll see in the months ahead. I think it was great to see a good number, but I think it was a head fake.
Okay.
You know.
Well, time will tell.
Time will tell. And the last comment I'll say is, one of the things, I mean, nobody wants to talk about the R word, recession, but, recessions are part of, you know, economic cycles. And I think we get ourselves and have gotten ourselves into this idea that, the Federal Reserve is supposed to step in and stop any type of recession from ever happening. And in some cases, I feel like it gets made worse. If you look at COVID and you look at how much demand got pulled forward, because we stimulated demand during that period of time. I mean, we had GDP numbers that were ridiculous. And so, I mean, the idea that we can't revert downward even slightly as the economy kind of normalizes itself is silliness. It doesn't mean we have to have we're going to see a 2008, 2009 type scenario. I certainly hope we don't see anything like that. I don't think anyone's really predicting anything like that, except for the people who are always predicting stuff like that. So, it's possible that we could have a very shallow recession where the data says, hey, technically we're in recession, but it's not horrifically being felt, across everybody, all these different sectors. And so I think that that would be fine.
So our clients that know us know, some we often like you kind of look at things a little bit more positively sometimes than I do.
Yes.
You're definitely glass half full, and I'm kind of like,
That's why we
maybe
work.
glass. That's why we work well together. Because I'm thinking, okay, maybe the odds of a deeper recession are 25%.
Mm-hmm.
I would prepare for it. They just think personally, take some precautions to be ready in the event that we do see job declines. We do see people unexpectedly have less income. Right, prices
Right.
continue to increase or not level off as fast as we think. And so what would that mean? What are some things that we could do? You're right, the Fed doesn't have a lot of tools. I mean, the Fed can increase money supply,
Right.
they can increase rates, lower rates. It's really like a blunt instrument, right? There's no scalpel to the Fed. It's like
And if
we
you look
crank
that
rates to
typically they tend to overreact on both sides.
correct. And
They tend to keep the spigot on too long, and then they tend to turn it off when they shouldn't and tighten when they shouldn't, or over tighten. It's
correct. The
again,
2020 rebound from COVID wasn't because we had amazing ingenuity in businesses being formed. It
right.
was because capital was extremely cheap, and they flooded the
Yes.
market with we increased money supply, buying bonds, lowering rates. It doesn't create necessarily the right environment for good businesses to be formed. It creates an environment for a business. It's like there's money, now we have to find an idea. So here's cheap capital. Now let's go find an idea versus, hey, I have a great idea. Now I need to go find capital. We just inverted it. I mean, that's what a SPAC is, right? It's a
Yeah, well, that's
special
what they
acquisition
took is
company.
they took all those
Right.
those quote angel investing, private equity ideas that, given time and, having to stand on their own 2 feet, a lot of those don't make it. But when everybody has capital free flow to invest that cost them nothing, and then you get some ingenuity behind it, like, hey, let's bundle these ideas and let's just offload them to the public and give our people a way to exit using public investors. Yeah, it was pretty dirty. It was pretty
Yeah.
dirty.
Pretty dirty. And so I think so I don't want the
It's like
reverse to
that movie,
be
The Big Short, where the guy, Ryan Gosling is explaining to the hedge fund about how the banks have bundled all of these garbage mortgages, into these, you know,
yeah,
CDO type of instruments, and they're like, "What?"
yeah,
And
it's
it's the
back.
same thing with the SPACs. It's like, this garbage bundled in, with a nice bow on it, and they let it go out for the retail people to buy. And of course, everybody had stimmy money, so
Right.
all you had to do was pump it, you know,
Right. Right.
good old pump and dump.
So I think the swing back, could it be the Fed was late to move.
Yeah.
I think that's as obvious as it can be. So now is it going to be an overreaction to cause a more severe cooling off of demand than what is really warranted?
Well, I think that's well, the Fed can only, and this is part of the conversation we had the other day or yesterday. The Fed can only do so much. The Fed's not going to, impact gasoline prices. Like the Fed's not going to be able to, impact some of these things that people are thinking, oh, well, the Fed, they're raising rates. So but it is going to impact certain sectors of the economy that need capital and can't get it, and they choke it off at a time where we might be moving into a scenario that capital maybe needs to be loosened up a little bit. Not because we need to, QE ourselves into infinity, but because, if businesses need credit or some other capital needs to be, loosened up so that they don't have to start laying people off. Um, you know, it. it's going to be interesting to watch to see because, of course, the Fed is now saying, "Hey, we're data dependent," and we'll see if they stick to the script that they've laid out, or if they truly start scrutinizing these numbers more carefully.
You got it. All right. What else you got up?
So I wanted to just because I knew that inflation numbers were coming out today, I did a little digging and I came across this interview with Howard Marks, and Howard Marks is well known in our industry. He writes a lot of memos that are fairly lengthy for
Mm-hmm.
your average person to read, but they're usually just full of nuggets. But this was a great little interview that he gave. It was about 11 minutes long. I'll put the video or the link up for people if they want to go watch it. But it was funny because basically the lady that was interviewing him, was asking him about how he normally gets questions like, should you buy or should you sell? And he just said, that's really the wrong question. A lot of people want, should I buy? Should I sell? What should I do? And he said that the number one job for you as an investor, he says every investor should have a sense of their appropriate risk posture. And that is based on their resources, their needs, their goals, their position in life, and their ability to handle volatility. And then once you know your appropriate risk posture, then you start asking yourself, will you maintain that type of risk posture and allocate your assets appropriately, or are you planning to vary over time? And if you're planning to vary, then it's like, well, how are you varying today? And I just thought, that's
Mm.
kind of goes back to what we tell people all the time is, if you create a plan for yourself and, you working that plan, then the question isn't, well, what should you do today? The question is, well, how has your goals, how have your goals shifted? Has something happened in your life that has made you shift, your the direction that you want to be heading versus the buy or sell, is the market too high or too low? And then he gave this great little nugget, and then I'll kick it over to you for your thoughts. But he says, the question was, which is worse, to buy high or to sell low and fail to get back in? And, because a lot of people, I hear this all the time, and I know you've heard people, like, they'll say, "Oh, the market's high." And he said, if you buy high, there is the risk of, maybe seeing some disappointment because in the short run you might see a pullback, or, things correct a little bit. But the long-term trend is positive, and the goal should be to reap those long-term rewards as an investor. He said, but if you sell low and you fail to get back in, then you run the risk of missing the recovery, missing the trend, missing those long-term rewards and hurting yourself. And so I thought that was a key piece of insight because, of course, a lot of people are dealing with that type of thought process right now, especially when, this year has been a very challenging year for markets. So your thoughts on that?
Well, I think the point I would take away from that is what what should lead our investment changes. So our risk tolerance, our return tolerance is probably personal. So something changes in our life, meaning you have an unexpected job change and you lose income. That could be a warrant. That could be a sign. Hey, we need to reevaluate our our investment time horizon. It could be a health event that pops up, or a constraint, right? That's now applied to your life that wasn't there before. So
Mhm.
it could be anything, right? It could be someone in our family has a disability now. We have to redirect resources there. That's a major event that should change your investment profile. I think the way we should really focus on our personal investment strategy is what's happening within our life that might change those time horizons or constraints. So, for example, if you're used to saying, "Hey, I probably won't need these funds for 20 years," I'm going to make some systematic contributions to it. So I know there's going to be periods of time where the price is going to be too high, and there'll be periods of time where it's lower. I'm just going to
Right.
continue to kind of systematically buy in. But then something happens in your life and changes that. That is the time to go. Okay,
Mhm.
hey, what do I need to do differently, if anything? And that's when you should go and seek some guidance and counsel on that. Just because things are happening in the market doesn't necessarily mean we want to deviate from our plan. Because if all things considered, we're still on our same trajectory and we know when we're going to need those funds for it, that really shouldn't impact us.
Right. I mean, and I think that that's a big thing that, we get convoluted a lot. And one of the things that I've been kind of chewing on a little bit is, it comes from a podcast that I listened to recently. And it's Meb Faber's podcast, and he was talking to Dan
Meb.
Ariely. And I think I shared this with you, but Dan Ariely is a professor. He's written a couple of books, very intelligent, on the behavioral psychological side
Mhm.
of finance. And anyway, he made this comment, and he said, we have, just as as a culture, we've taken things like consumption and made it public. Like, like the car you drive, the house you live in, the clothes that you wear, the material things that you own and can purchase, experiences. You think about Instagram, you go to Instagram, and it's just, everyone's highlight reel of what they're doing in
Uh-huh.
life. And he says, but we've taken things like saving and, proper debt management and investing and insurance. And basically I'll bundle that and say, like wise financial moves. We've taken that stuff and we've made it private. So so if you think about like your neighbor, we know a ton about what your neighbor is, what they're spending money on, their consumption habits, but we know very, very little about their internal financial life, like what they're saving, what they're investing. Do they have appropriate insurance? Do they carry a lot of debt? Do they not? And he said it's made it such an unfair competition when we look at comparison. And so that's what made me think about that was, I don't know about you, but in the last 3 or 4 months, I have fielded more questions that have been generated from conversations people have had with other friends or neighbors. And so I know that the people are out there talking, and I'm like, you don't know. A lot of times you might be getting I have all these fun names like Nate the neighbor, Wanda the coworker. These people that are giving you financial advice or telling you what you should do with your money, you have no idea what they're doing with their money. Like, you
So
have no
that's
idea how healthy their financial balance sheet is, but yet you want to hear their advice.
so
It's crazy.
that violates rule number one of wealth accumulation, which is you compare yourself to yourself. That's the
Right.
comparison. So you violate rule number one, it's going to be tough
Yeah.
because you're going to get sucked into the FOMO of I missed this idea, I'm not going to miss the next one, and it's going to be great, and I'm going to make 10,000% return, and I'm going to go buy a Jeep, and I'm going to go. And you just compare yourself to yourself. That's the only comparison. Where was I last year compared to this year? What things have I done to help bolster my
Right.
own financial success or wealth accumulation? And I have a big, how I feel about this. I say calculate your net worth every year. You got to have a barometer. Where am I? And you
Right.
got to celebrate those periodic milestones. It's kind of like we talked about it a few pods ago about kind of progressing to a black belt in jujitsu. You didn't
Mhm.
walk in one day and they hand you a purple belt. Like you start at the bottom and you get beat up and it's not fun. And
It
and
it
you
takes
need
time.
people ahead of you to take mercy on you or you won't make it. And I think of that about that a lot, right? Um, so it's a progression, but it's your progression. It's your path. Does it
Right.
matter how fast someone else got to a black belt if you get there? It doesn't.
Right.
Does it matter if someone else skipped the belt or stopped going? It doesn't. And so it's your journey and what your success is should be defined by what you want to achieve. And so you've got to kind of block out all the rest of it. Anyway, Morgan Housel has the best quote on this. Wealth is what you don't see.
Right.
Most people want to spend $1 million. They don't want to save $1 million.
That's
That's
a
a two
great point.
different, right? It's two different paths, right? There are a lot of people
Yeah.
that want to spend $1 million and they will. They
Oh, yeah.
will. And there's a small group that wants to save $1 million. And so again, not to stay on the psychology of money, I feel like we talk about this book all the time, but you know, there is a balance between enjoying today versus being able to take control of your time in the future. Because really, this is kind of the the way I would frame retirement is you have the ability to do what you want, when you want, with who you want, for as long as you want.
Right.
That is retirement. It doesn't mean people reach that goal where they have saved enough to financially retire and they immediately leave work. They don't. They do what they want for as long as they want with the people they want. And then when it's not fun any longer, they leave and they go do something else. And that is the time. That's what I'm working toward, right? How fast can I get to that level where I want to do what I want, when I want, with who I want, for as long as I want? And that's my motivation for doing it. So it's a different perspective. You start looking on Instagram and all the social media feeds and all the other nonsense. It's just a torment. It's a tormenting process that doesn't lead to any satisfaction, any
Right.
happiness, and it doesn't help you achieve what you want. So it's just a waste of time. So just turn it off.
Yes, I agree. Sometimes it's
Sorry about
easier.
my rant here.
No. But sorry, sometimes it's easier said than done to turn off the social. But it's kind of like the same thing. Like, you use the analogy of people investing. I think about the other thing. We work with a lot of folks that are planning for retirement, and there's a lot of especially what we just talked about at the beginning of the podcast, how fear was just running rampant. A lot of people are telling other people, oh, you need to get out of the market, you need to abandon your plan, hit the eject button. And I'm thinking to myself, like, these folks don't know anything about your long-term plan. Like, and you don't know anything about how they handle their own money most of the time. This is just people talking shop. And unfortunately, people take that type of stuff to heart. And it's like there's this, when fear spreads, it's contagious. And so anyway, not saying that there aren't things to be concerned about. There are, but there's always going to be stuff. There's always going to be stuff to be concerned about. I mean, when the next big thing breaks, it'll be all we hear about for, a couple weeks until the newness has worn off and we're used to it. And there'll be the next crisis of the day that we have to endure. So I have one more thing for you
All
if you
right.
got time for me, man.
I do, man.
This
Come
was
on.
a
We
this
start, we're kicking off season.
Yeah.
Look at this face. Shave the beard.
Oh, you know what? I
Come
had
on,
not even
man.
noticed that you shaved,
Oh
brother.
my
I did not
gosh.
even
I
notice.
tell you what, all these mosquito bites on my face, though, getting
Yeah.
eaten alive in here.
So
All right, fire away.
I saw this question on the Twitter,
Oh
and
boy.
it made me think, and so I'll pose it to you and hear your response first.
Okay.
The question is $1 million a lot of money?
So, yes, yeah. Do the majority of people have $1 million? No.
Right.
I mean, it does $1 million buy what it used to 20 years ago?
Right.
No.
Of course not.
Does it mean that that's all you would want to have saved for retirement? No. I mean, it just depends.
Sure.
We have met clients retire on half that amount and be completely financially secure because they are accustomed to living a lifestyle that allows for the income that you can safely generate between that
Right.
level of savings and Social Security cover their financial expenses.
They live within their means.
Yeah.
Right.
On the end, I'm sure there are people out there who have saved $2 or $3 million and are probably pressing up on the maximum amount they can withdraw to live their lifestyle.
Yeah, so I thought that about that question because I had, my answer was a two-parter. Like, is $1 million a lot of money? Yes. So like if someone said, hey, I want to transfer $1 million to your bank account today, I would, have a celebratory steak dinner and probably plan my first my first trip.
Right.
But the second part of my answer was, is $1 million a lot of money for a 30-year retirement? And the answer to that is, it don't buy what it used to, right? Kind of like what you were saying. And I think that is something that I want anyone that is, listening to our show, planning for retirement. I don't want to discourage anyone. I still think, as financial advisors, our job is to kind of meet you where you're at and do our best to help you craft a plan that can meet, give us a chance at meeting your goals. That being said, I think a lot of folks have anchored to the idea that being a millionaire means you've got it made. And I think that there still are some things that need to be looked at when if you have saved well and you've done a good job. That doesn't mean that, all things are clear. There's still risks out there that could, impact your ability to do exactly what you said, Ross, which is go where you want with who you want for however long you want, and have that type of retirement lifestyle that you want to plan, that you are thinking about when you think about retirement. So, just because, if you feel really good about your balance sheet, that's fantastic. Doesn't mean you should not plan. You should still plan. You should still be creating um, investment strategies, processes that you think are going to help you achieve, sustained retirement lifestyle that you want.
What else should we talk? Is there anything else we missed? Are we going to root for the Panthers this year, or is David Tepper just soured everyone in South Carolina?
Man, I'm going to be honest. As a
I'm
Rock Hill native, I struggle, man. I struggle. I mean, the Panthers are still, I do. Listen, I'm probably in the minority on this.
Hey.
I'm probably in the minority on this, but I do have a little soft spot for Baker Mayfield. I love his attitude. I love that he's
gonna
just
be scrappy. But guess
he's
what?
a
I'm
prickly
not spend
pear. I love that.
to go watch him play in the stadium. They're not getting any money from me.
But no, I am a little bit irritated with Tepper and his shenanigans. So I probably will tune in and check out my boy Joe Burrow this year and the Bengals.
Oh, buddy. Let's go. All right. We're going to make a trip to Cincinnati to go see a football game this year.
That would be an interesting road trip. I don't know.
Maybe. Can we get him on the podcast?
I don't know. They played in the Super Bowl last year, so tickets for Bengals game were probably going to be astronomical. It's not the Bengals of old where they weren't winning any games. It might be cheaper to go see the Browns play if we're going to Ohio.
All right, man. Well, look, it's good seeing you. And
yes,
thanks to all of our
thanks for everybody for allowing us a hiatus over the summertime to do family things and get out and about and and have quality of life like we tell all of you. But we are back. We're excited, and thank you for listening to the show. We'll talk to you next time.
See ya.